Gateway growth.
Stock options. Stock options could refer to companies offering their employees stock options as a form of incentive compensation. Those are known as ESOs, employee stock options. But we ain't talking about that. We're talking about options, the type that take advantage of stock market movements. Options are derivative contracts that give the holder the right but not the obligation to buy or sell an underlying security or asset at a predetermined price before the contract expires. A derivative is a financial security with a value that is derived from an underlying asset. An underlying asset could be a stock, bond, currency, index, etc. For example, a Google option will be a derivative of the Google stock. The option moves as the stock moves. Every one options contract is a contract to buy 100 shares of a stock. The expiration date for stock options in the US is the third Friday of every month, but it can be weekly. There are two types of options, calls and puts. A call is a bet that the stock will rise, giving the holder the right to buy a stock at a specific price by a specified date. A put is a bet that the stock will fall, giving the holder the right to sell a stock at a specific price by a specified date. The right to a call or put option comes with a price called a premium. The premium price is primarily influenced by the underlying asset price versus the strike price, aka intrinsic value, aka delta. Time value into the option's expiration date, aka time decay, aka theta. The volatility the market expects the stock to display up until the expiration date, aka implied volatility, aka vega. Bid price is the price that the buyer of the option is willing to pay for the premium. The ask price is the price that the seller of the option is willing to sell the option at. After purchasing an option, there's a few ways it could play out. For simplicity, let's assume we did a call option. The underlying stock price goes up to the strike price or past it. On or before the expiration date, the option holder exercises the contract, buying 100 shares at the agreed price, profiting on the price difference. The underlying stock price goes up to the strike price or past it before the expiration date, and the option holder decides to trade the option to someone else now that it's worth more, profiting off the difference of the higher premium price. That's me. Worst case scenario, the underlying stock price drops further from the strike price. On the expiration date, the option expires worthless and the option holder loses the premium they paid for the option. Only about 10% of options are exercised, 60% are traded, and about 30% expire worthless. People use options for income, to speculate, or to hedge risk. Short-term options are those that expire in less than a year. Long-term options expire in a year or greater. Your profit from an option will be taxed during tax season. Options held longer than a year and a day will be taxed at a favorable long-term capital gains rate. I'm no CPA or professional trader. Build your resources. Use Investopedia. Google EYL Earn Your Leisure or YouTube the Come Up series to get some great tips on investing. Do you invest? Do you trade options? Let me know right here. Warning, option trading involves risk and is not suitable for everyone.
Gateway growth.